Sanjay Mookim, India equity strategist at Bank of America Merrill Lynch. He's joining us on the show this morning. Sanjay, thanks very much for taking out the time. All of the big events out of the way, election, now budget. How does one approach the next 6 months of the year? And what should the investment rationale be now?
Okay. Good morning. I think the answer to your question is that one has to be now extremely bottom up and look at individual stocks for the next few months. Because if you think about it, India is going to be devoid of any top-down macro event until really the next budget in February. And you can debate whether that's going to matter as well. On headline, which is the index, MSCI India or Nifty, India will continue to move in line with what is happening to EM. Right? In fact, the corrections we've seen in the last 2 days, for example, were accompanied by weakness in the region as well. If you get, let's say, a resolution to the trade wars, maybe EM has a rally, India will probably also see a rally. But the hypothesis for equity investors, to my mind now, has to be to wait for a growth recovery in India. Right? There are some green shoots, and we can talk about that. But if you are buying equity for growth, then you need to go off benchmark. You need to be very company specific, but you also need to be patient. So again, very bottom up, very company specific, a little bit boring. That's how the market's likely to be for the next few months, I think.
So then would you divert your attention to, the broader market space, if that's the approach that you're going to be taking? And whether or not this discount differential that we're seeing between the large caps and the mid caps because of lack of quality names available to invest in the market will sort of come off?
So yes, and that is the incremental trade really, because you start with assuming that India's growth weakness as we are seeing today may be temporary, that their liquidity easing that we are seeing now, that lower interest rates will prompt a recovery in demand and aggregate growth in the economy. And for that, you will have to buy growth stocks. Now, large caps have re-rated. There has been a herding in large cap stocks. The relative gaps in multiples for mid caps versus large caps is no longer adverse. Mid caps are now almost at the same multiple at large caps are. They probably need to be at a discount, but again, we're not paying a premium. So if you believe the growth is coming back, then like I said, you need to look at the broader market. You need to go off benchmark. The question here is of timing and making sure that you get the cycle right. And that's why I said that you probably need to be very patient when investing in markets at the moment.
Sanjay, good morning. Neeraj here. What was your first or what was your initial post-budget note looking like? And do you think because of the taxation issue, which thus far hasn't seen any comments coming from the government, on the flip side, some of the FPI investors and particularly Cat 3 AIFs might look at India as an unfavorable destination? Have any of your clients voiced concerns with regards to that?
Well, I think there was at some point some confusion on whether the tax is applicable, but I think with time that's becoming clear that as the letter of the law stands, it does apply to a lot of these investors. And our sense that it will apply to a majority of people who are currently investing in India from abroad. Now, we've got to figure out what is the treaty arrangements and can they get exemptions against that and all, which is not, which has to be worked out. But I suppose that everybody is reconciling eventually to having to pay slightly higher tax. Now, my submission here, Neeraj, would be that, look, if you can make returns in India, then a 3%, 4% higher tax may not deter investments, especially if you had good ideas to invest in, per se. I think the bigger issue is for most investors is that they kind of not have too many ideas, especially if you're a long short hedge fund looking to invest in India. And that, I think, is a bigger reason for people to stay away.
Okay. No, so I'm just trying to get a sense. You reckon that tax by itself is not necessarily a deterrent for any of your large clients. They are taking essentially a macro call on India and not taking a tax call currently.
Yes.
Okay.
Correct. So I'd put it this way, that look, if you were convinced that you can make 20% returns, the tax doesn't matter.
Are clients convinced they can make 20% returns, Sanjay?
No, they're not. And that's what I was saying, that look, the market is currently extremely devoid of ideas. Its conviction is missing. And that's the reason the activity might be low.
Okay, fair call. What about the slightly medium term, Sanjay. And I don't know what your research team estimates for Q1 are, but we were talking to the Citi team day before or yesterday, and their assessment was that Q1 for their coverage universe could see a mere 3% growth. Titan has sounded a warning. Sanjeev Bajaj spoke about the consumption space looking weak. HDFC Bank numbers won, at least the advances won the strongest. And TCS numbers give an indication of all not being well with IT either. We're looking at a damp squib of a Q1.
Yes, so if you leave out the banks, and financials have a specific issue of base effects, lower provisioning and so on. In fact, in our coverage universe, we are looking at a 14% decline YOY. Now, this of course depends upon which stocks you're covering and so on, so it might matter. But the sentiment we'd echo that across the board, it's either down or decelerating in a way. And therefore, this quarter is not going to be the redemption for markets if you're expecting any sort of green shoots in numbers. So this quarter and possibly next quarter is likely to be under some pressure. I think the hope for the consumer pack is really the festival season. And if you can create some sentiment and create some momentum around the pujas and so on, then you might see some earnings surprises, but otherwise it's going to be relatively weak.
You know, the festive season last year was also much anticipated with regards to a possibility of a pickup for the auto sector, which didn't happen then. And, you know, the way we are headed at this point doesn't look like it could be much of a game changer even this time. We've got Maruti sub 6,000, M&M has moved lower, its P multiples much lower than even its 10-year average. You know, would this actually be looked upon as an opportunity, or till you really don't have a clear indicator how things are picking up on ground, you might as well be safe on the side?
So look, the impulse is to suggest, Devina, that look, any weakness becomes an opportunity, especially if you are a medium-term or a patient investor, right? So when it looks like doomsday and people start talking about structural issues with economies or companies, that's when you try and take a counter view in investment. My concern is that yes, look, it's happening. The expectations are falling at the moment, but multiples do not fully reflect that. So even the auto names, some of them are still close to 20 times 2-year forward EPS, and much of the correction in stocks has begun. EPS has fallen. So either I buy the recovery or I buy the multiple. I don't think in many cases I have either of that available today. Right? So yes, if it remains as gloomy as it is and expectations continue to fall, it will become a good opportunity for somebody looking at the long-term investment in India.
Any interesting observations, Sanjay, that your research has been able to throw up with regards to, a trend that you've picked up, or some data point that suggests that, probably there could be some concerns with regards to a further pullback, or there could be a bigger upside to the equity markets?
In fact, we've done a lot of work on this, and the answer to this is that there is no trend. So what we did as a team is we went and read the transcripts of all consumer-facing companies in India, because companies provide a lot of commentary in their results when they talk about what's happening on the ground. They may not print it in numbers, but they at least talk about category-wise consumption demands, trends, etc. We put it all together, and the conclusion is that there is actually no trend in the consumption weakness. So you cannot say that it is a rural slowdown, you cannot say it is an urban slowdown or a mid-market or a mass market slowdown. There are patches of weakness everywhere. And the correlations the market tends to talk about also are not evident. For example, the state with the worst auto sales today, which is Maharashtra, is the state with the best loan growth. So this assumption that it's the liquidity crunch that has caused this slowdown is certainly not valid. And therefore, our argument in that note was that this consumption weakness is actually very idiosyncratic. Okay, there are very bottom-up reasons. There might be sector-driven drivers that are causing slowdowns, and therefore, investors should not be worried about a macro weakness, etc., but focus on bottom-up, focus on what's happening to every company, and track every company bottom-up if they have to catch the turnaround. Okay, because clearly there is no clear answer to why this has fallen off a cliff, and you might miss the move up if you start looking at only the macro and top-down.
Sanjay, I want to go back to the question on whether your larger investors are looking to invest in India from a growth standpoint. I mean, we just received a note from HSBC, and obviously not to say, to comment on that, but they're talking about China being a bigger destination from a valuation standpoint, from a growth standpoint, demographics being better in China versus India. Do you think all of this plays up on the mind of the foreign institutional investor while taking a call on India?
Well, the last bit certainly doesn't seem to be true. Demographics in China is worsening. Their labor force is contracting. India's demographics, or India and Indonesia, are probably the only two large countries where demographics are still favorable on a global basis. Right? But I'd step back and argue that, look, and we've put it in a note, that growth is actually very hard to deliver. If you look at all emerging market countries prior to the GFC, almost every country delivered at a minimum 5% dollar per capita GDP growth. Right? 5% was par for the course, everybody was above it. Post the GFC, only 2 or 3 major countries have grown even more than 2.5% dollar per capita GDP. That's China, India, and Bangladesh, if I remember right. So within the EM pack, you have 2 broad conclusions. One, that an investor should not have been in EM. Post GFC, growth happened far better in DM than it did in EM. But within the emerging market pack, it's countries like China and India which have grown, if at all. And therefore, they still tend to attract the interest of EM dedicated investors. Okay? And there can be a variety of reasons why this happens, and we can talk about it. But I would argue that within a weak EM, India still looks like one of the shining parts.
But the premium that people were paying for growth, is it justified anymore?
Okay, so that is a very big debate, and again we've done some work on this. I've argued earlier that the premium multiples that have been applied everywhere in the world, and this is not just a phenomenon in India. If you look at, let's say, the PE multiples for Unilever in India, Unilever in Indonesia, and Unilever globally, all 3 Unilevers have re-rated in the same lockstep. Right? The charts are almost exactly the same, whereas the growth profiles of the companies is very different. Okay, so it's not just growth that has derated. My argument is that you've also seen a re-rating of the low wall of earnings. So companies which have relatively visible earnings, low risk earnings, have also seen a multiple expansion. Okay, so again, that's a technical aspect. But the reason that you kind of get a premium, or at least in theory, is because you have better growth outlook than your peer set. So one, it's a cost of capital correction, but you have better outlook, which I am arguing that at least in the case of India is somewhat justified. Now, whether 50 times and 70 times is the right number is a debate. I don't agree with that number, but at least the market seems to be comfortable with it.
Sanjay, there are some developments that are happening within specific sectors that are idiosyncratic. Aviation, for example, jet was an issue. Now we've had Interglobe promoters also having a bit of a spat. It's a small pocket, but one that's actively tracked and global in nature. Do you guys have any thoughts here?
No, we don't cover this space, unfortunately, Neeraj. And I don't track it myself, so I don't know if I can comment on this too much.
Oh, fair call. What about how would you approach banks? Now, the difference would be that this time around, the corporate-facing banks or some of the PSUs, large PSUs, might have a write-back of provisions which might make the bottom line look strong, but the loan growth and the top-line growth may still not be visible. How do you decide whether that's positive for the stock, because the bottom line print will be showing, but the top-line growth will not be there?
Okay, so in one of our notes previously, we have argued that banks or financials is the one space that does not react to EPS or EPS upgrades or downgrades. Almost every other sector and company, the stock tends to move with earnings upgrades and downgrades, other than for financials. Now, if you think about the outlook for financials, the fact of lower provisions, the fact of these write-backs is very well understood by the market. However, an environment of slow growth and falling rates is actually negative for the profitability of these banks. It's negative for the forward ROEs that these banks might deliver. So on incremental development, which is the fact that growth is slowing, loan growth is slowing and is likely to remain weaker for some time, and that rates are falling, you might be a little bit concerned on banks. The only reason I suspect that they still hold up and there's still a lack of selling out of these banks is because there's nowhere else to go, right? If banks are a very large part of index weights, most funds are sitting with 40, 50%, 60% of allocation to banks. And if you cut that weight, you really have a problem allocating that money elsewhere, especially with IT, like you said, also appearing under a bit of a cloud at the moment.
Sanjay, would you say that, while obviously when you're not talking about just pure play consumer staples, all companies related to consumption, say for example, your consumer discretionaries, you have your auto angs, you have your staples, you have things related to consumption, farm income. Is that the theme, a central backbone that you would suggest that probably one can go by instead of the bigger theme like investment, or would you say vice versa now?
No, I would not say that. Look, let me say two things, right? That I am not too concerned about the volume growth trajectory of consumer names over a 3-5 year period. So the argument that India is structurally slowed down is not true. In fact, I was saying that we are hopeful that the growth momentum will actually improve. So volume growth is possibly likely to stabilize, come back. Even for the auto space, I would argue that if you give it a year or two in time, the growth numbers will probably look much better than they are today. The question really is for expectations in terms of margins for many of these companies. They've seen significant benefits, and consensus needs to probably cut those numbers a bit over time. And then, of course, is the valuations you're paying for them. Now, if you don't worry about these multiples, at some point you will have to look to go back into the consumer space. I think it's a little bit early at the moment.
Sanjay, you spoke briefly about IT. I'm just wondering if the base case on the currency or the base case on the dollar is dollar weakness, and therefore a lot of emerging market currencies strengthening and maybe India strengthening as well. In light of that and the fact that banks and retailers might all pull back spending, would IT, would other exporters all be largely underweight?
So we are currently overweight on IT, and it's worked so far this year. And the question is really what you do now that you've earned some alpha on IT. And I agree, the concerns that you highlight on not just the currency, but in terms of the end demand as well, and plus margin pressures, these do tend to imply that you'll see some sort of downgrades happening for IT earnings. I think the question that most investors are grappling with, especially the benchmark investors, is where is the downgrade going to be the least? Because if you go sector by sector and company by company, in most cases you're looking for downgrades. So I think again for IT it becomes more of a relative call than an absolute call, which is why we haven't yet cut our overweight position on it. But yes, on an absolute basis, I think that downgrades are more likely than upgrades for the IT space as well.
Okay. Sanjay, what about pharma? Again, not a space that has really performed. There are idiosyncratic issues with each of the companies as well, but exporting theme. But again, the whole argument about how if the US is indeed slowing down, if the currency is indeed looking like strengthening in India, does that sector remain an underweight if you were underweight on it in the first place?
So the problem with pharma, like you said rightly, Neeraj, is that you have to be very company specific. You cannot basket buy pharma because of a macro theme. Once in a while you could do it, but not on a daily basis. And therefore there are some pharma companies we like, some pharma companies that we advise against. In many cases the multiples are fair. I mean, I don't think that the multiples have become cheap yet in a lot of these companies. So it could be a decent place to have some allocation, but again you've got to be very company specific in this space.
It's very interesting, Sanjay. Just going by the nature of the places where you are either overweight or underweight on, I'm guessing, and correct me if I'm wrong, but I'm guessing that you're not highly overweight on the capex revival theme, are you?
No, we're not. So we have. See, the problem with being a capex revival theme is that industrials has only one large cap stock in it really, and that has a modest weight in the index. So how much of it can you buy? So what ends up happening is that people then buy cement, buy some of these ancillary, possibly look at some NBFC mortgage sort of lenders in order to express their rising investment hypothesis. So A is very difficult to express in terms of portfolio construction. But no, we've actually downgraded some of our industrials names recently because we think there is no further impulse to capex in the country, and multiples have gone up of late.
Sanjay was just looking through some data with regards to stocks that are trading on the Nifty 50, stocks that are trading at a discount to their last 10-year P multiples, and how the return on capital employed for some of these names have moved. So for some, growth, 10-year growth CAGR still seems to be in their 20s, 17%, 20%. But the return on capital employed has dropped drastically from highs of about 25 to 30 to single digits. Is that something that one can use as a benchmark or a demarcation right now to sift through and probably pinpoint stocks that could be the big multi-baggers of tomorrow?
Well, I have a feeling that many of the stocks you're looking at would probably be SOE or PSU stocks, which clearly seem to fit that description. Now, the trouble with the PSU stocks is that with the supply that the government is promising, and of course the return of cash through higher dividends, and I don't know buybacks will happen or not now, but many of the balance sheets and the technical overhang on these PSUs remain. So some of these are attractively priced as well. Single-digit PEs as well. But as a strategist, I have been advising clients to stay away from PSU companies because there's just too much of an overhang from the kind of supply that we're expected to see over the next few years. Okay, but no, I think your broader question on, let's say, ROEs, if you look at ROE of the Indian market, it has been steadily falling for the last 10 odd years. People have stood out and said this is it. Profit to GDP or profit metrics in India is at an all-time low. It must now therefore go up. I don't think that has worked, or there's any logic for why it should go up from all-time lows. So I think, again, going back, you still need to see which company is executing well, where the prospects are better, and I wouldn't look at the aggregate metrics and hope for turnaround in just that.